Today, Devin and I are going to be talking about predicting involuntary prepayments in Texas. So this is our Capstone project. So first, we're going to be talking a little bit about Finance of America, the company that Devin and I are interning at this summer. So what is Finance of America? It's a non-bank multi-channel originator. So Finance of America has multiple business lines with multiple channels of diverse assets, including commercial, residential, and reverse mortgage loans. So it's mostly in real estate. So some background market analysis, some threats that Finance of America faces include economic factors such as the downturn from COVID-19 that happened recently, some home price depreciation, and low stock of homes. So some further opportunities that Finance of America could expand into include ESG efforts, such as making loans more accessible to low-income applicants and increasing the number of minority applications. And some competitive strategies that Finance of America currently employs include the diversification of assets by offering several different loan products, such as the commercial, residential, and reverse loans that we mentioned before. And here in these graphs, we included the top 5 states and the top 5 CSAs with the highest number of applications that Finance of America received in 2021. So as you can see here, California, especially Los Angeles and Long Beach, that CSA, we had our highest number of applications there. Okay, so some more background on our topic today of prepayments in Texas. So what is prepayment risk? It's the risk of a premature return of principal on a mortgage loan. So when this happens, investors will not receive interest on the prepaid portion of the principal amount. So there's two types of prepayment, and we're going to be mostly talking about involuntary. So involuntary prepayments is when the defaulted amount on loans that terminated is due to foreclosure or short sales.
Yeah, so now we're going to talk about the actual data analysis we did. So we started off by cleaning and exporting our data from Snowflake using SQL. And we performed our actual analysis primarily in Qlik with their machine learning algorithms, but we also performed some of our own analysis in R using RStudio and Excel. And you'll see some of the graphs we made in RStudio and Excel coming up. So moving on to the actual data that we are analyzing, we looked at the Fannie single family performance data set and the Leading with Data Science Snowflake data share. We're looking only at Texas for this analysis, and our dates are from January 1st, 2020 to December 1st, 2021. Some of the loan level data we're looking at from this data set include original interest rate, original unpaid balance, original loan to value, debt to income, borrower credit score at origination, things like that. But we also added some macroeconomic data like unemployment rate, HPI change, mortgage rates, and treasury yields, just to get a more complete picture. So looking at our entire data set, we see that involuntary prepayments make up a very small portion, about 1%. Most of our loans in this data set are kind of clustered around the 3% to 6% interest rate region. But when you look at loans that actually involuntarily prepaid, those are kind of clustered in the 7 to 10% interest rate region. And a thing to note is that we only saw 7 observations that were in this 9 to 10% bucket, but we did see a much larger number in the 7 to 8% and then 8 to 9% regions.
Okay, so next we have LTV versus the frequency. So as you can see, these are relatively high numbers. And then some other background information on DTI, there's a great amount above 0.3. And then here for original unpaid balance, there's a great amount that's on the lower side that's skewed.
And we should add that these last 3 graphs we just showed you were for all data points in the data set, not just the involuntary prepayments. So after uploading our data from Snowflake to Qlik, Qlik ran a few of its machine learning algorithms, and the one that performed best was this random forest classifier. So random forest classification is basically a machine learning algorithm where you have a bunch of decision trees that are meant to be uncorrelated from each other. and each decision tree will spit out its own prediction for an instance. So, for example, in this image in the bottom right, decision tree 1 predicts that this instance is class Apple. Every other decision tree has its own prediction, and then the forest, which is a collection of trees, which is why it's called a forest, um, it'll basically employ majority voting to get its final output. And so here, 2 of the 3 predict that it's an apple. So the final prediction of this random forest classification model is apple. And that's the model we went with for today's presentation. We're looking at the correlations matrix from Click right now. A couple of things to note. We see that original interest rate is very highly correlated with whether we see an involuntary prepayment or not. We also see that borrower credit score at origination has a negative correlation. That makes sense because if a borrower has a high credit score, they're perceived to have a lower credit risk and are therefore less likely to actually experience involuntary prepayment. Other factors that also had a correlation include original unpaid balance. That's a negative correlation. And previous month loan factor. So our model performed pretty well when comparing our predictions to our historical model. One reason for that could just be the small number of involuntary prepayments that we actually observed, but we're pretty satisfied with how the model performed overall. Looking at which features were the strongest predictors of whether we saw an involuntary prepayment or not, original interest rate is number 1 by a pretty decent amount. Previous month loan factor is also a pretty significant predictor, and that's just the ratio of the current unpaid balance to the original unpaid balance, but lagged a month to account for any prepayments. And also property valuation method ended up being a pretty significant feature. Once again, interest rate, previous month loan factor, but also borrower credit score at origination and original UPB. Those are pretty important as well when looking at our features in the model.
So to conclude with our summary results, so to reiterate, the factors that most likely are going to be helpful in predicting our involuntary prepayment. So we have original interest rate with a positive correlation, and then we have previous loan factors and borrower credit score at origination with negative correlations, and then property valuation method was also a big factor.
Yeah, so these findings we actually do think make sense because interest rate is strongly tied to a borrower's risk level. So if a borrower is perceived to have more credit risk and are going to be less likely to pay off their loans, then they'll get a higher interest rate than a more trustworthy borrower. A higher interest rate also means greater monthly payments for the borrower, and so that means that they may be less likely to be able to make those payments. Lower previous month factor means that a borrower has been making payments for a longer period. If there's a high previous month loan factor, that means that the borrower probably hasn't been making payments for very long, so there's probably less risk of them experiencing an involuntary prepayment. Credit score as well also is meant to predict how likely a borrower is to actually repay their loans on time. There is a strong possibility of collinearity among interest rate, borrower credit score, and unpaid balance because they all kind of they're all ways of assessing whether a borrower has high credit risk or not. But interest rate ended up being the strongest predictor in our model. So some ways Finance of America could incorporate these findings going forward. The measures of borrowers' creditworthiness that typically are used have proved to be effective in determining whether they're likely to involuntarily prepay or not. Property valuation method is interesting. I'm not really sure what was going on there, but I think it's worth looking at and investigating, what valuation methods are used for different borrower profiles. That could be interesting to look at on a company-wide scale. Also, these macroeconomic factors I mentioned, they really did not prove to be an effective predictor of involuntary prepayments in Texas. That could just be a limitation from looking at the data in one state, but it's interesting nonetheless. So most of these loan level data points tended to be much stronger predictors.